Good evening, everybody. It's Richard Bowser once again from Property Investor News. Got a lot of content for you tonight, all centered around commercial property. So let's see where we go with this. Right, lot to get through, so let's crack on. 5-minute presentation from me, just a market update. Then we're over to our sponsor for tonight, CPC Finance. Got a great case study presentation from Carl Griggs, who's the MD of CPC Finance, and he's going to be taking us through a very, very interesting case study from a mixed-use commercial conversion of retail premises, and that ties in nicely with our main presentation tonight from Suzi Carter. Yeah, so that's the schedule. Right, so property investing, what's ahead in 2021? The big question, of course, at the start of the year, and given what we've experienced in the last 11 months with COVID. So what's changed since March last year? Well, clearly, as we are doing tonight, and many others using this technology, these technologies now, Zoom, GoToWebinar, and some of the other ones, and that's enabled people to do things on a scale which, quite frankly, you know, we hadn't seen before. And clearly lots of small businesses, office-based businesses, are voting with their feet and working from home or working from not necessarily, you know, in you know, the digital nomads, I think, is a phrase that's being used. So where do people want to live and work? Not what. Now, compared to 11 months ago, do they want to work in city centres, as increasingly over many years with urbanisation we have seen in terms of office work, or now are people looking more towards the suburbs? Or are they looking more, given the choices that we now realise that technology allows us, looking perhaps to the commutes to within an hour? And of course, if you're going into your office stroke business, which is in a city centre or a large town centre, and you're doing that 5 days a week, it can be a real grind if you're up at 6 and not getting home till 9. And of course, you may have young children, etc. So, you know, you would perhaps want to do that within an hour. Many people say 40 minutes is you know, the optimum period for commute. But now, of course, with the whole working from home and the way that society has evolved, and not just in the UK, this is across you know, many countries now. People are re-evaluating their lifestyle, their options. They're perhaps considering whether, you know, they can live two hours or more away from their place of work. But if you're only going into that place of work 2, 3, 4 times a month, then you'll put up with the one day in the week or the few days in the month where you've got a 4 or 5 hour trip, whether that be by car or train or whatever. So that's what we're seeing. That's what we've been seeing. And of course, you know, as we unlock, hopefully for the very last time here in the UK, thankfully after a successful, very successful vaccination program so far, you know, all things being equal, we can look positively at normality unfolding. But what have we seen in the last 10, 11 months? Well, as I mentioned already, the whole working from home, working from afar, adapting, internal space absolutely has been, you know, prioritized, and people are reevaluating, and that's obviously led to a boom in the residential property market, particularly away from London. And you know, if my daughter's a teacher, she's got 3 children, and you know, if you're doing your work from home, you're having to do distance learning, and you've also got 3 children. You know, my daughter is far from alone in having to juggle that. And of course, many of you, I'm sure, will be very familiar with what I've just said. But of course, green space is also not now far more valued, and outside space. So small flats without any external space in congested centres, maybe you know, that's not perhaps where the future is for some developers. And of course, for property developers, you know, historically they've looked at the transport links, the proximity, taking into account the attractiveness for commuters. who are weighing up the travel time versus the cost. But perhaps, going forward, for developers, that may be not necessarily so important for some of their clients and customers. So will the big offices in the cities, the likes of what we have in the City of London, we've got some of these buildings with 5,000 to 6,000 people within one building, which, in order to work efficiently, large lifts has to whiz up, 20, 30, 40, 50 floors in the blink of an eye. But with COVID and the whole distancing, is that practical going forward? Or perhaps by the autumn, will we be through this and we will be unmasked, and that type of big office will continue? But of course, the likes of Canary Wharf, the City of London, the Manchesters, the Leeds, Birmingham, all of these have buoyant, or historically have had buoyant city centres in terms of offices and other occupancy for commercial activity. And of course, there's the supporting industry, the support services around that, Pret and Starbucks, feeding the office workers who are time compressed. So that's another, issue which has arisen out of COVID. Turning back to something I've already mentioned, so will tenants and occupiers value small flats with no external space? With people, however, without children, younger people, the 25 to 35s without children, will they value more being close to city centres, a walk or a cycle ride or a short bus hop? Will they value that more than green space and larger internal spaces? Because historically, what we've seen in the last 10, 15, 20 years with UK city centres is that people were prepared to exchange denser living accommodation for proximity to the social life, to the nightlife, to the restaurants, the bars, the theatres. But that's, of course, all been in lockdown pretty much since March of last year. So that's pretty much the two themes. I just wanted to set the scene for tonight, some things for you guys to think about. Some of the stuff that I've already mentioned, we've covered in Property Investor News magazine. In our January edition, we looked at job creation from jobs in technology. We highlighted Leeds as a city centre where more and more high value jobs are being created related to technology. And Leeds was the standout, and I think of all the cities that we looked at in the UK in terms of the data. We also looked at the burden of landlord taxation. Of course, now with Section 24, we're into the final phase of this tax drive against private landlords. We also looked at property development funding and tech adoption in the funding, crowdfunding and peer-to-peer lending. And we ran the first of commercial property opportunities in 2021. And tonight's main presenter, Suzi Carter, is the author of that first article in the January edition. And finally, in the February edition, which subscribers to Property Investor News will be getting tomorrow, our lead feature is all about the cliff edge that's coming with stamp duty, the stamp duty holiday, the holiday that was given by Sunak back in the early summer. And of course, there's a cliff edge potentially ahead in terms of transactions, and something like 100,000 property transactions are being forecast to fall through because of the delays in conveyancing, driven also by COVID, the working from home, and obviously practices are not as efficient as they would be. So that's our lead feature in the February magazine. We've got a good piece from Helen Chorley about what is your risk appetite. That's really one of these sort of, looking in the mirror and questioning what is your appetite for risk. And of course, lots of people have suddenly discovered risk, that property investing can be risky in the last 10 or 11 months. The key interview for the February edition is all about repurposing retail. So continuing this theme of commercial property and converting. It's about shops and tops, that's a trade term. And it's with a very, very experienced developer down on the South Coast who's actually put together 350 projects in the last 8 or 9 years. That's not individual rooms, that's projects, a serial property developer. And that interview with a case study from one of his latest projects down in Brighton and Hove is in the February edition, which subscribers should be getting as of tomorrow. And the second episode with Suzi Carter on commercial property opportunities is also in the February issue, along with a whole range of other articles. Right, so if you found that talk useful and you're not a subscriber to Property Investor News, well, there's an opportunity to subscribe. If you do subscribe, you'll get the magazine, the February magazine. You'll also get a free book on auctions called Before the Hammer Falls. If you subscribe tonight online, do email me. There's my email address, and let me know that you've subscribed, and then we'll get you that free edition and also the book. Right, so that's my talk tonight. So Carl, are you there, sir?
Yeah, all here and ready.
Suzi, are you there with us? Hi, Suzi.
Hi.
Yeah, so sorry, complete incompetence on my part. So if you wouldn't mind coming on the stage earlier, and then we'll go with Carl's slides later. So we'll swap these around. Okie dokie. Right. So there's Suzi, if you can see her on your screen. So Suzi Carter from Strong Oak. She'll introduce herself and run you through her slides, and then we'll have some time for questions afterwards, and then we'll revert and have Carl's slides. As I say, Carl's slides do complement what Suzi's presenting on. It's a really good case study on this. So yeah, it's well worth looking at. So let's get across to yourself.
Great.
So hopefully everyone can now see Suzi Carter's slides.
Good stuff. I'm just so relieved it's not me for a change, because that's usually my party trick. So good evening, everyone. Good evening, everyone. Thanks for having me. Thanks for having me, Richard. So 2021, here we are, and I'm going to talk to you this evening for about half an hour about investing in commercial property in 2021 and what that might look like, some of the trends that I think I can see emerging, and a little bit about the market. So there's quite a lot to get through. So without further ado, I will click onto the first one. So first of all, I just want to tell you a little bit about me and why I'm qualified to talk to you about commercial property. So first of all, I'm a chartered surveyor. I've been a chartered surveyor for scarily over 25 years now. And I've specialised in commercial property ever since, well, before I qualified and ever since. I started my career out at CBRE, where I managed, I was a graduate obviously, but I managed Regent Street for the Crown Estate. I also did a stint in offices and industrial when I was at CBRE. I then went to work for Kingfisher, the big, well, in those days, the really big retail conglomeration. So B&Q, Woolworths, MVC, Superdrug, Comet. Obviously, a few of those aren't around now. So that group looks very different today. But I went to work for B&Q, which is part of the Kingfisher group. And they were the heady days when B&Q were acquiring their kind of 150,000 square foot stores. And they were in a massive race for space with Homebase. And my job, it was a pretty big property team, about 100 of us. And my job was to acquire new sites for B&Q and basically to grow their market share by acquiring new sites, getting planning, developing out brand new warehouse stores. And we used to acquire about 12 to 15 of these every year. But eventually it got to the point where they'd acquired too many. And growing market share became a kind of big cost overhead. So the acquisition program slowed down substantially, and I went to work for Land Securities, now rebadged as Landsec. In those days, up until actually the last year, they were the UK's largest property company, the largest real estate investment trust. They've been overtaken now by Segro, who are an industrial specialist, and that will I'll be talking about why that is pretty obvious, I would think, you know, because Land Securities basically specialise in retail and London offices. So my roles there, I was director there. I managed a large portfolio of retail parks, and then I managed a nationwide portfolio of shopping centres. But I left the corporate world in 2015, various reasons for that. I'd wanted to set up my own business for about 10 years, so I eventually got around to doing it. And now I had a couple of small children when I left Land Securities. I'm still a chartered surveyor. I still do some consultancy for corporate clients. I've got my own investments. I invest in residential, and this year I'm kind of specialising in resident. You know, I'm basically going to invest in commercial. That's all I'm going to be investing in. And I also run the Commercial Property Academy, which is an online coaching program in commercial property. So, without further ado, I don't need to tell everybody what happened in 2020. Two massive generational events. COVID, we all know about. I won't bore you with that. But also Brexit, and I don't think the full effect of Brexit actually has been fully felt yet. And you know, these are, in 1 year, to have these big generational changes, it's going to upend the market. And, you know, I think that the market is being artificially supported at the moment through furlough, through government stimulus, but that is going to end. And, you know, there will be some fallout from both of these things. So I'm going to talk about the effect of these on the commercial property market. So, institutions like pension funds, investment companies, REITs, high net worth individuals, family offices, they invest in commercial property for a very good reason. And overseas investors from all over the world, actually, you know, sovereign wealth funds, they invest in UK commercial property as well. And the reasons that commercial property is such a kind of institutionally acceptable asset class is that it's generally very good business tenants with great tenant covenants. You've got long leases, and you've got inflation-linked leases, so regular upward-only rent reviews. And you know, you've got believe it or not, we've got a stable government. We've got you know, a very regulated sector. There's a lot of law and regulation surrounding commercial property, and as a result, it's a very, from all of those aspects, it's a very attractive asset class. And you know, the three main sectors that institutions like pension funds, etc., have been investing in for many years, and obviously they have a certain allocation to put into property every year. So they have specialist funds, and they set up retail funds or industrial funds. Oh, sorry, my clicker's gone a bit strange. Or office funds. So retail, offices, industrial, the three main commercial property sectors. Now, over recent years, in the last kind of 10 years, some of the big institutions have kind of diversified from that, and they've moved into the hotels sector, leisure, build to rent, purpose-built student accommodation, but they still are a pretty small proportion of the overall makeup of their property portfolios. So for all the reasons that that institutions invest in these three asset classes, investors, smaller investors like you and me, have been investing in them. So I'm just going to take you through kind of each of these markets and kind of explain where I think the markets will be and where they will moving to in 2021. So first of all, retail. Well, I'm not going to, I think you'd have had to be hiding under a rock for a year to kind of not realize what's happening in the retail sector. So I'm not going to dwell on that. Obviously, COVID has had a massive effect on it. I personally don't think we've seen anywhere near the end of it yet. And, you know, when furlough ends, I imagine there will be further fallout, sadly. Just some things I wanted to draw out really with regard to retail. So first of all, there's a change in the structure of leases going forwards. Now, you know, traditionally, I would say, even when I left the retail sector, the corporate retail sector in 2015, lease lengths were reducing, turnover rents were being introduced. So turnover rents is where, rather than getting a fixed rental that comes in monthly or quarterly, the landlord basically shares in the turnover success or the trading success of the store, and gets paid a percentage of the turnover of that store. Now, it's absolutely wrought with difficulties because you've got to rely on transparency between landlord and tenant. It necessitates much closer relationships, and then there's all kind of other problems, like, for example, do you net off online returns from store sales? All these kind of things that you encounter with turnover leases. So the trends were starting in that direction, but all COVID has done across all the sectors has basically accelerated the trends that are happening in the market. So with more supply of product, more supply of shops on our high streets, it becomes a buyer's market, it becomes a tenant's market, and therefore, we're definitely seeing the change in the structure of leases going forwards, much more flexibility of leases being required from tenants, because basically they can. And so they're looking to introduce turnover rents, shorter leases, more flexibility of leases, break clauses, etc. And that's definitely a trend. Now, that's not going to happen across all retail. So I'm going to talk about a little bit about later that kind of how you can pick your markets to invest in. And it's just be aware that not all retail is going to fail, not all retail is going to have these kind of leases, but this is definitely a trend. The absolute overriding factor, I think, in commercial property investing for this year is to check your tenant covenant. The tenant covenant is the kind of the quality of the tenant, the financial stability of the tenant you've got in your property. And of course, a stack of tenants haven't been paying rent. And even the ones that have, I hand on my heart, even the big brands, I couldn't necessarily say that they're absolutely as rock solid as they once were. So we'll hear later about kind of the finance market, but mortgage companies, banks are still wanting brands in shops and in offices, etc. They're still financing brands, but actually, sometimes I think local operators, especially in this market, are actually more stable, more able to pay rent than some of the big brands. And maybe have some more longevity. So it obviously depends on who you're talking about, but just definitely do your checks and balances. Check accounts, Google them, look for market intel. And also, if you can't get a good tenant covenant, or you think they're a bit shaky, ask for guarantors, personal guarantees, rent deposits, etc. Valuations are definitely being rebased in retail. Now, this is an interesting one because it's like it's a kind of split market. So in shopping centres, big high street stores, eventually valuers have they like a bit of death by a thousand cuts. They like reducing valuations gradually, but they are rebasing kind of valuations. Shopping centres have had, they've been culled, absolutely culled. But I've been putting quite a lot of offers in on retail recently, and I'm finding it a really competitive market at the kind of lower levels, which is really interesting. And it's actually very competitive. So I expect that to change, by the way, by the end of the year. But it's interesting how that end of the market hasn't quite caught up with, but it will do. It always does. And I just don't think some landlords have felt enough pain yet, unfortunately, for them, I guess. There's obviously a huge raft of permitted development opportunities that have been introduced, and that they are fantastic opportunities. On the 28th of January, the consultation finished for the change from Class E to residential, and we're expecting, I'm definitely expecting that legislation to come in to allow the conversion of Class E to Resi. So we'll wait and see. But the government's trying to make it easier to convert retail. As I said, brands aren't always best in this market. Some local niche operators, perhaps not at the moment because everything's closed, but when things open up, I imagine will, especially because people are working from home more, perhaps may do better. But even the brands are, like Costa Coffee, other brands are looking to actually locate more locally than they were previously. Previously, their strategy was to locate in town centres, city centres, and now they're definitely looking to locate more locally to be nearer their customer. And as I said to you, kind of local shops are, I think are quite a good bet in this market actually. And obviously not all retail will fail. You know, you read the headlines, but there's, you know, there's certain geographical locations and different types of retail that will weather this storm. And so, and I'm going to talk about that later. In terms of offices, well, you know, pre-COVID, we saw the office to residential permitted development right. So what that did was actually reduce quite a lot of supply of offices in towns, and therefore, you know, there's actually a bit of a scarcity of offices in some locations, which was interesting. It was actually pushing rents up in some locations. Since we've all started working from home, obviously, that there's been new permitted development rights, you know, airspace rights and conversion rights. And, you know, where are we with this, you know, this working from home versus being in the office? I mean, personally, I think that the office isn't dead. I think that the way we work will be changed. I think certain industries it'll be not affected that much, but I think there'll be a lot of others where headquarters will be collaboration space. They'll probably be downsized over time, and there'll be kind of local working, whether that's from home or in local hubs. And you know, I definitely can see that as the future of the office. Obviously, a lot of offices, a lot of businesses are tied into leases at the moment. So you know, don't expect to see that happen all at once. It'll be kind of a drip-fed thing over a number of years. And I definitely expect to see the rise of the flexible serviced office, the more local office, because I don't know about you, but I'm kind of sick of my own four walls. So if I was working locally, it'd be kind of nice to go out to a local flexible office that I could, you know, grab a coffee and you know, see a bit of life rather than just being at home. But obviously in the short term, that needs to be socially distanced. In terms of industrial, obviously industrial covers a huge range of different types of unit, from kind of industrial parks, standalone units, logistic distribution warehouses, showrooms, just general use industrial cold storage, data centers. You know, it's heavy industrial. It's a massive sector, industrial. So to say that logistics is all of industrial is definitely not true. Obviously, logistics has been the go-to sector for the institutions now. So what they're basically doing is they're moving away from retail, and you know, they are probably quite overweighted in retail, a lot of these funds, and you know, as a knee jerk, they're moving their money into logistics. But you know, there's only so much logistics that's needed in the UK, and it's very, very expensive. And of course, when you're trying to build a balanced portfolio, as we all are, and as pension funds are, you can't just kind of pile into one sector and just invest in that. So I'm going to come on to in a minute why the pension funds and other investors, including smaller investors like ourselves, are going to have to look to diversify their investments going forwards. But there is a growth market. There's a number of key sectors within the industrial sector that actually, I think, really tick the boxes in terms of the emerging trends that have come out of COVID. But don't forget, with industrial, you know, you've still got contamination and noise potentially if you're buying that type of investment. And as I said earlier, there are other commercial asset classes like student housing, build to rent, hotels, leisure, all responding differently to the changes that have happened as a result of COVID. You know, student housing at the moment, short-term hit, probably will recover, but at the moment isn't really de rigueur for institutions. Build to rent, a very kind of, it's an emerging market, I would say, in the UK. If you compare it to what's happening in the US, it's very much a kind of at the beginning of its cycle. Hotels obviously all closed, but you know, I imagine they will recover. And leisure, again, I think that we're all going to want to experience this post-COVID. So I imagine there'll be a leisure bounce back, but obviously what damage has been kind of done to leisure in the meantime. So if you wanted to flip a coin, kind of where should you invest your money going forwards, and kind of, you know, what I'm really spending a lot of time doing at the moment, and I have been for the last kind of 6 months, is looking at where the new waves are, where the crests of a waves are coming, you know, the new trends that are coming as a result of COVID, because the whole market kind of has been turned on its head, and what I wouldn't give to be where he is at the moment with that beautiful sunshine. So I just going to take you through just a few types of property that I think, you know, where do you put your money at the moment if you're an institutional investor? Where do you put your money if you're a small investor? And you know, there are some emerging trends that are coming out of it. Now, I appreciate not all of these will be kind of accessible for everybody, but just kind of gets you thinking about kind of how you could kind of tick the boxes and tick the trends with your commercial property investing. So the first one is wind farms. You know, anything to do with, and I'm going to go on to EV charging in a minute as well. You know, anything to do with sustainable energy has got to be a good thing. And don't forget what you're looking for with your investments is longer leases. You're looking for good covenants, and you know you're going to get this with wind farms and sustainable energy. Multifamily in the States is built to rent over here. It's such a much more sophisticated market in the States, and I definitely expect to see this emerge as a much bigger institutional asset class in 2021 and beyond. You know, that it's done quite differently in the States, and I think there's a lot that operators can learn from what's happening in the States. So I do expect that sector to get more sophisticated over the next few years. Then you've got health. I mean, it's pretty obvious that health is going to be top of the agenda for a number of years after COVID. So, you know, I'm not just talking about doctors, dentists, you know, I'm talking about physios, chiropractors, osteopaths, you know, all great tenants to put into your vacant retail property, or, you know, maybe you don't do conversions above, but, you know, put health in. And then, you know, kind of things like beauty salons, etc. You know, anything that offers a service and kind of health-based to do with the body, I guess. I think is just going to be massive going forwards. There's going to be so much investment going into the health sector as well. Cold storage, well, these things are big, bulky beasts, but cold storage, which is basically where online grocers will store their their fresh food, and where vaccines are being stored. And you know, so this has got to be a massive growth sector. Then you've got car parks. Again, you know, you tend to have long leases, and I mean, not at the moment, but usually amazing income from car parks, you know, and really you don't have to do much development. They're just kind of bits of land with some lines drawn on. They're much more complicated than that, but you know, effectively that's kind of that's definitely, again, this is definitely going to be something that institutions are going to be moving into a bit more than they were previously. Data centers, for obvious reasons, everyone working from home and kind of the rise in online, and EV charging. You know, if we're not going to be making any more petrol and diesel cars by 2030, then this has got to be a massive growth sector, and you know, something that I'm looking at quite carefully. So just about a word about COVID-19 then and the effect on the market. So it's basically exposing big differences between sectors, markets, and geographical locations. So there's definitely no one uniform response to COVID-19, and therefore you know, each sector is responding differently, and each geographical market is responding differently. There'll be winners and losers. New trends will emerge. I've kind of already gone through a few of those, but there'll be loads more. And you know, what we need to do when we're looking for trends, you know, and what we're going to invest in, need to look at whether, you know, short-term trends as a result of COVID will actually become waves. So good example is, you know, as all working from home, you know, I wouldn't imagine that everyone will be working from home going forwards 5 days a week. You know, it'll be more of a mix between the office and at home. So just kind of, it's important to pick through the kind of short-term trends and look at which ones are going to be, you know, just more sustainable into the medium term. And obviously, you just need to do your due diligence to make sure you exploit the right opportunities in the right location for them to work. Pricing has softened, but as I said earlier, you know, I think in some sectors pricing is still strong. I mean, Industrial pricing is very strong, especially logistics. But I've found that even retail with uppers is absolutely flying off the shelf at the moment. And I do expect that to change. So I'm putting offers in at the moment for the market in 6 to 9 months rather than the market now. Obviously, in this kind of market, and in any market, have multiple exits and try to ensure income from day one to kind of protect your investments. And really, the main thing that I'm kind of banging on about quite a lot at the moment is niching, and the article that's going to be in the February issue is all about niching, because I genuinely believe that's where you're going to get the competitive advantage in your investing, by kind of exploiting some of these trends and taking advantage of the sectors and the markets that are going to be responding well to the fallout from COVID-19.